This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. On the podcast today, a return guest, one of my favorites, Eric Crittenden of Standpoint Funds, a trend-following managed futures type trader. Eric brings a very practical, no-nonsense approach to the markets and to life, a perspective I like to think that I have, but I always enjoy Eric's view because he comes at it through angles that sometimes I'm a little fast and furious, and Eric's very thoughtful. Gives you the perspective that you might not see or the perspective you might need to see. You know the base of this podcast, trend following. Enjoy a little more of that trend following perspective with Eric Crittenden. I think when I have you on, I always get to pick the mind of a professor to some degree. And you're looking very professorial these days, by the way. You're falling right into it, huh?
Yeah, it's the gray hair, man.
Even though you've got your approach, you know what you want to do every day, you still are having to take care of people and their hopes and their dreams and their savings. And that always brings a little stress, doesn't it?
Well, I would say that now is probably the least stressed I've been in living memory that I can recall. So, I mean, on one hand, look, we just do one thing and do it well and do it the way we want to do it. That's the way to live. I would encourage everyone to try to approach that in life. I have just managed to get there. I don't know how well it's going to work going forward. You never do. But I can tell you that my stress level is as low as I can ever remember in my life.
You bring up an interesting point because we've talked before and we don't need to go into any prior stuff because right now you guys are on a roll at Standpoint. Things are doing well. People are believing in you and they're believing in you by putting their capital with you. But I guess what's interesting is the foundation, and maybe you can explain how this happened. But the foundation is, and you just alluded to this, you're doing it your way. You put your flag down. You said, this is what we're going to do. This is how we do it. Do you like us? We'll communicate with you. And that's it. You haven't tried to be all things to all people. You decided who you are, and then you've asked people to come join you.
That's right. In fact, we use that phrase a lot. Don't try to be all things to all people. Stay disciplined, have realistic expectations, and know what you're trying to do. And we're trying to finish a marathon here.
The marathon never ends, though.
No, it never ends. It's basically the course of your career. It doesn't do us any good to produce alpha and have great returns 5 years in a row and then be down 60% in 1 year. There's enough products in the marketplace that do that. We try to be humble, grind, and do the right thing, manage the risk along the way. And we plan on being there at the end of our careers, which is another 25 years for me. That's just a different philosophy than what you'll see in the marketplace from a lot of different products and funds and firms.
When you sit around, you have that conversation with yourself where you're not talking to me on a podcast that maybe a few people might hear. What's the most important conversation that Eric has with Eric every day?
Well, I think there's two. There's the client-focused conversation. Are we doing a good job of connecting potential clients with the reality of what it is we offer? That's always a challenge in our industry for some reason. Are we doing the best job we can? And then internally, are we doing the best job we can at actually managing money? It's kind of a paradox. One of the unsung attributes in this industry is not tinkering and changing things. Don't get in there and let your fear or your envy or any of these other counterproductive features of the human mind get in there and mess up your investment strategy. That comes across sometimes as a lack of effort on your part or a lack of continuous improvement. So balancing that where you have to do your research, you need to be aware of what's going on in the markets and don't get caught flat-footed or be surprised by anything. But when you have a good system in place with good rules, truthfully, you just don't need to change it very often. And I feel like people err on the side of changing things too frequently because they're afraid of feeling or looking lazy.
Interesting self-analysis that you could believe that other people, and when they're thinking about you and your type of strategy, that there could be a lack of effort because they might perceive there's not a continuous improvement. But to say that is to really not understand what you do.
True. But what I've learned, and now I'm 51 now, been in the industry for over 25 years. And what I've learned is that it's almost impossible to get most people to understand what it is you and I understand. And it's not really realistic to expect them because they haven't been in the trenches and done it. So they can't really appreciate how counterintuitive a lot of these important points are.
But you know what's interesting is you state that. You say, okay, all the years that yourself, myself have understood this type of thinking, strategy, philosophy. But even as a young man, I mean, some 20-something-year-old guy out there could have his eye opener. He could read a book, he could see an article or whatnot, and he could go, oh, I understand this idea of trend and following and quant trading. And they could have that light bulb moment before they even get to having the 25 years of experience you have. But then there are so many people that I will bump into, and you alluded to this, that they go through a career, doctor, attorney, whatnot, and they never get to the point of where that 20-something had that light bulb moment of going like, hold on, who was this guy, Jerry Parker? Who was this guy, Tom Basso? They never have that moment. And they get to later on in life, and I think that's the hard part, is when they get to later on in life, it's like, how do you fill in that blanks when they never first had that aha moment that there might even be some of these achievers and philosophies and strategies out there in the world?
I think you could probably say that about most disciplines in life. Look, if you take somebody off the street and you put them in the octagon, mixed martial arts, they're going to make every mistake in the book and they're going to lose. So it takes, in my opinion, at least 10 years. First of all, you have to have the talent to do it, and then the commitment. There's going to be losses along the way. There's going to be a cost to learning these things. And that applies to almost all disciplines, whether you want to play the piano or be a fighter or be a professional soldier or a doctor or whatever, or a nutritionist. When I talk to nutritionists, they're just aghast at how little the average person understands about nutrition. So I don't think it's specific to our industry, although it is a little counterintuitive that so many participants in our industry spend so much of their time agonizing over things outside of just the term structure, the liquidity, and the price movements, which is what you and I look at, and consider more things like fundamentals, as if that isn't already discounted in the marketplace. We could talk about that for weeks. That's one thing where people can go all the way to their end of their career and never see the aspects that we see because they're too mired in the details and the minutia of the fundamentals.
And when you're not mired in that minutia, it gives a certain freedom in life that you can never go back to being that way. I just saw this being in the States for a month over the holidays. I had a conversation with someone, family member, where you could see that pursuit of the fundamentals. If I just talk to the next person, or I heard this, or I heard that. My thought when I have that conversation is like, well, I don't say this, but I'm thinking in my mind, don't you realize you can't get there? There is no there. There's no ending to the strategy that you're proposing.
It's hard to drive that point home. You're up against Wall Street and all the marketing and everything else. What did it for me was because I'm a database guy, double majored in computer science and finance, I was able to collect empirical data and simply test these assertions. So one of the things I did right before I read your first book, The Turtle Trading Rules, maybe a year before I read that book, I worked for a family office and they were absolutely determined to utilize analyst projections and recommendations and all these external factors in their stock selection. So what I did was collect all this data and regress it against outcomes. It was very surprising to me at the time to see that doing the opposite of what the analyst told you to do was more profitable than following them. One of my coworkers here likes to point out, how often does the US stock market finish between, 7 and 9% gain for the year, which is basically every analyst's prediction at the beginning of every year is S&P is going to be up 6, or it's going to be up 9, or it's going to be up 7, or whatever. I think he said one time in the past 50 or 80 years or something like that, has it actually fallen in that range. So it's either up 20 or it's down 10 or whatever. There's just more tails. There's more action. The analysts are just empirically wrong about things, especially at key inflection points. Having the luxury of seeing that with my own eyes and being able to test it empirically freed me from the chains of always having to second guess myself and defend why I wasn't following Wall Street research or analyst projections.
What's interesting, the way you phrase that experience, you had this internal drive, this desire to prove it to yourself. You hear all these voices, particular analysis, but you say, well, hold on, what does this look like if I run it through the machine, so to speak? This desire to prove it to yourself, not just to accept what might sound like, well, that was a nice piece of research for JP Morgan and Goldman Sachs. My gosh, that guy's so smart, and look at his resume, et cetera, et cetera. But you had this desire to prove it. I think that's what's unique in people that I come across is I self-select these days. I perhaps try to have conversations with people that think like me. That's probably not good only to be like that. But so when I bump into people that don't do what you are laying out, which is this desire to prove it, to not just trust but verify, that's rare.
Yeah, I've always been a skeptical person. Even as a little kid, I asked too many questions and I like to play devil's advocate and essentially pretend to be an attorney, arguing one side and then argue the other side. And then if there is any data lying around, formulate a hypothesis and, like you said, run it through the machine and see if the base rate statistics are even remotely close to the assumption. And what I find is that in most aspects of life, it's just not true.
Let's go into 2022, an interesting year for people that have a belief set about a certain strategy that you and I have. Do you think 2022 moved the needle at all on the typical 60-40 mindset? Or is it just another one of those years and things keep marching on?
Time will tell. I mean, it should have moved the needle. That's the data point that you needed at almost the worst possible time as the baby boomers are going into retirement. Pretty much the last thing they needed was a big drawdown on both their stocks and their bonds as they go into withdrawal mode, which is what we've all been talking about and warning about for 15 years. Is it enough? I've seen some interest. I think it's for the wrong reasons, though, most of it. And most interest in alternatives that's fear-based is usually for the wrong reasons. But that data point is certainly telling. It shows what can happen. And now people have actually felt it. It's one thing to show them historically, look, you would have had multiple years like this in the 70s before World War II. It's another thing to actually feel it with your own money. When you had a portfolio worth $5 million and it went down to $3.7 million or whatever, to see those, to experience those nominal losses will give you a new level of respect for effective diversification. But I think it remains to be seen. I think there needs to be more pain before people say, you know what, I want more diversification than what I have with just stocks and bonds.
Let's talk a little linear and nonlinear. I saw the example the other day where I was reading an example about just typical airplane flight, pilot at the controls, and within normal operational range. Look, I'm not a pilot, so any of you pilots out there, don't kill me. But look, you can make slight adjustments and things are going to be fine. But if you get outside that range, people don't necessarily understand that you can go from being linear to nonlinear. If you get just a little bit too far outside that range, and too far outside the range might not be to the average person, might say, well, I can deviate. It's going to be okay. But once you get to that nonlinear place, that's where really interesting, unexpected things can happen. Black swans, whatnot. Speak to this. Put your professor cap on and take the baton from me and explain a little bit more, because I think it's really important for people to, especially if they're interested in having a conversation with someone like you, understanding where your world is, this linear to nonlinear is terribly important.
Yeah, I find that concept is hard for people to relate with unless you put it in real world terms. I studied meteorology before finance, and I'm from the Midwest, from Kansas, where you're going to get some of the most violent weather in the world. And the reason is because all that cold, dry air comes out of Colorado and Canada and mixes with that warm, moist air from Houston and Austin and Baton Rouge. And that is a toxic brew for incredibly violent weather. In Kansas, they have a saying, if you don't like the weather, just wait 10 minutes. And I remember a day where it was 83 degrees and sunny, and an hour later it was below freezing and there was hail. And then it snowed and we had a thunderstorm in the snow and a tornado. And I went without power for 5 days. So we went from a linear to a nonlinear in a heartbeat. And if anybody from the Midwest is going to understand that, where everything seems fine. As soon as something changes, though, everything goes off the rails. Surfers understand this too, with respect to everything can be going great, but the tide is moving. And when the tide goes out far enough, a certain sandbar starts triggering the waves, and the waves become much more powerful and hollow and fast. Or if the swell direction shifts from west to northwest, well, then a certain reef will start picking up the swells. If the wind direction changes, minor changes can completely change the system and how it works. So financial markets are very similar. There's parallels to meteorology and surfing, where if interest rates just hit a certain level, that's the level at which hundreds of billions of dollars worth of projects flip from black to red. And then you get all this groupthink domino effect of decisions being made. And then credit agreements get shut down and swap facilities get overwhelmed. And you don't know where that level is because you don't know where everyone's at with respect to how much money they've committed and whatnot. 80% of the time, things can be range bound and they can feel normal, lulling people into a false sense of security. But as soon as one thing gets outside of the normal boundaries, it can trigger other things to quickly get outside the normal boundaries. And then those linear relationships that you've built your risk management plan on, that you've built your day-to-day behaviors on, a lot of the rules change. And some of them can even invert and start doing crazy things. And we've seen this time and time again over the last 3 years. I was on several podcasts before COVID, and people were asking me if crude oil prices could go negative. And I thought about it, and I realized, well, yeah, the futures price can definitely go negative if the cost of storage exceeds the salvage value of the asset, the crude oil itself. And I got tremendous amount of hate mail, people saying, how could prices go negative? That's absolutely insane. And then 2 months later, sure enough, they went negative because there was too much crude, not enough storage. So you had to actually pay people to take that toxic substance and go do something with it. So things happen that are counterintuitive and that you feel like you couldn't have prepared for. But I feel like you can prepare for them if you're open-minded enough and you think in a nonlinear manner.
Imagination, having some imagination, given those examples on the plains of Kansas, to looking at crude oil, this is just imagination at play. Creative, nerdy guy who may be a little introverted, who just likes to analyze things. But this type of persona is great for just saying, hold on, what can happen? Anything can happen.
But the real power is not put yourself into a position where you have to predict it right. And that's why having a trend following philosophy and a risk management method in place allows you to not worry about getting the timing right. So when crude oil went negative, we were already short and had been short for 6 weeks because a trend following model essentially said, this thing's not going up and you've lost the risk that you budgeted for this position. So you're going to get out. And then it went down a little bit more. And it's like, well, now it's in a downtrend. You're supposed to be short. So we shorted crude oil, Brent crude, natural gas, heating oil, gas oil, all of them, not knowing that all hell was going to break loose and the entire energy asset class was essentially going to go negative equity, but then ended up being on the right side of that because of the discipline that a trend following model forces you to have.
I could think back to 99, 2000. I could think back to 06, 07, maybe early 08. I don't remember the exact timing of when the Fed started raising rates, but during those two periods that I just mentioned, the Fed was raising rates. When they started raising rates, equity markets were, hey, it's a party, baby. Let's go. Let's go. But eventually, as you state, there are triggers that take place that I don't know what the magic number is where the Fed could raise rates to, where equities say, see ya, we're going the other direction. But there is a number going back to the early 80s. Maybe it's over 10%. But I think what's interesting is that you're not trying to make a prediction as to, okay, whatever the Fed does with rates and when could possibly all hell break loose. Your system is taking that into account. But for the average person out there that doesn't yet understand Eric, doesn't yet understand your system, your approach, just looking at rates alone and past history in the last 25 years can at least, if people want to be honest with themselves, offer a little bit of fear.
What end, though? What do they do with it? If you don't have a plan that you're really comfortable with, that you believe in, that you're willing to stake your reputation on, it's hard to take something like that and catalyze it into action. Because like you said, you don't know when. People sell too early and then watch the market go up for another 2 years and they feel like they're left behind. And then now they're panicking and it just leads to bad behaviors. It's not enough to just be a good critical thinker. I would say that's the least important part. It's a necessary component, but it's the least important. It's actually having a plan and the discipline to stick with it such that you're prepared is more important than having a high IQ.
When you sit down and you're inside your strategy, you're inside your philosophy, your machine, so to speak, what are you trying to do? What's the goal of the machine from your perspective? The one that you've assembled.
The goal of the machine is to combine asset classes that have scale, reasonable tax efficiency, and durability into one portfolio that I think is the best compounding machine that I can commit to over decades. I say that because I'm a database guy and I've been looking at hedge funds, UCITS, mutual funds, ETFs, every futures market on the planet, forward markets, equities, convertibles, options, all this stuff going back to the 1970s, as much data as I can possibly get. Computers are so convenient and powerful now. You can just unleash them on all this data and you can test pretty much anything you can come up with. I've spent thousands of hours of my time over the past 25 years trying out every conceivable combination that I could come up with. What always came back as being the most durable was simply equal risk contribution from global equities and this thing called trend following. Just trend following on a diversified global portfolio of futures. Met all my criteria. Good tax efficiency, incredible scale, reasonable turnover, and a nice path traveled and able to handle pretty much everything that I've seen the market throw at us since World War II, basically. I thought, well, if I can pull all this together into one holistic strategy that can be run in a relatively simple, very durable and stable manner, that would be a great product that I don't really see anyone doing a good job of that's available to the masses. I don't want to say no one's doing a good job, but I'm saying something that's available to anybody that can invest in a mutual fund or an ETF. And then that happens to be my personal portfolio. In fact, I just, at the end of the day, before we started Standpoint, just made the decision that, well, if that's good enough for me, I know I can defend it and I know I believe in it. So we're just going to launch that as our product and we're just going to have one product. Our philosophy is do one thing and do it well. And it's that. So the goal is to just be a really good, disciplined, long-term investor that sources all the realistically available diversification around the globe.
What's interesting how you describe the opportunity that you see to deliver to, let's say, the average person on scale, and acknowledging that other folks have come before you. But many of the folks in the world that you and I are fascinated by, the structures in which they came along, let's say 70s and 80s, the typical Wall Street world gave them a lot of hoops to jump through, so to speak. It was difficult to get their product to the masses. And or a lot of them had enough interest from a minority of participants and such a nice fee structure that so many of the legendary names could just make a fortune. But now what's interesting is while some of these great names that you and I respect have been in these silos with these structures, here we are now in 2023. It gives a guy like you the opportunity to say, well, hold on. That silo structure, the fees have changed in a lot of ways, and I'd like to reach more people. It's interesting how it's evolved to where, I guess if it was always a level playing field, going back in time without assorted regulatory operations, creating this and creating that, it would have been interesting to play it forward to see if strategies could be chosen by the individual without assorted barriers, what would have happened. But it's interesting how you now in 2023 get to see a different opportunity because perhaps some of the legendary guys that came before you did not really have that opportunity. They had a great opportunity. It did well with it. They got to buy professional baseball teams. No cry from the Argentina, but interesting how things shake out, huh?
Yeah, it was surprising to me also because I started out in the family office, but then in the hedge fund industry. And then to see the regulations change, I don't want to say they got more liberal, they got harmonized. And the opportunity to do what we do in a transparent manner and offer it through just a regular old mutual fund vehicle. At first, I wasn't super enthusiastic about it because you can't charge a performance incentive fee. And you don't buy a baseball team unless you're charging a performance incentive fee. That's how you make $100 million in a year deal. But that's not really a good fit for my personality anyways. I don't need to make $100 million in a year. I just need people to trust me and my team to run this marathon. And we make good money just charging a regular management fee, but we're not excitable people trying to get rich quick. That's not consistent with our personalities or the product either. So ultimately, I realized that that is a great opportunity to actually make it available to everyday investors. And if you look at our product and our asset base, our clients are regular, everyday Americans investing in mutual funds. We have almost no institutional money. That's just a different area. Those people want managed accounts, hedge funds. We just run mutual funds.
Speak to your openness to being wrong. Could probably talk about that particular issue from a psychological perspective for hours upon hours. But in your world, my world, the openness to being wrong is a superpower.
I completely agree with that. So my philosophy on that is it's okay to be wrong. It's not okay to stay wrong. The most overlooked valuable thing on the planet, in my opinion, and I am strong in this opinion, is people overlook the opportunity to learn from failure. I've learned more by studying failure, probably by 10 or 20 to 1 ratio, than I ever learned from studying success. Survivorship bias, analyzing firms that failed, funds that failed, business plans that failed. That's where all the hidden gems are because no one's scouring through those. No one's doing a postmortem. They don't write books about failures. A little bit nowadays if the failure is spectacular, like an Amaranth or something, but 99% of the books out there are romanticized about successes. I'm sure you know. A lot of the success that ends up in movies and books was the result of being in the right place at the right time. There are not that many valuable lessons in there. Otherwise, you'd have these people that go to all these seminars and read all these self-help books and whatnot. It would be making a bigger difference. The real valuable information is in studying failure and learning vicariously through the experiences of others. That should be a whole major at every university, but it's not. I don't know why or where I picked up on that. I think it was the data science component of analyzing data and just seeing how many of these conventional wisdoms out there just are not true. And then inferring from that, okay, well, if it's not true and it's wrong, and this actually leads to failure net, then maybe doing the opposite would be successful. Just like a good baseball hitter doesn't bat 650. He bats 280 or 290 or 310. It means he's striking out 2 times out of 3. And the most valuable baseball players strike out most of the time, the power hitters. So understanding that, and like a trend following system, the best ones have about a 35 to 40% success rate, which means they're failing most of the time. And by failing means admitting you're wrong, taking your losses, keeping them small, moving on to the next opportunity. There's no shame in that. The shame is in staying wrong.
Survival is such an interesting idea. People don't think about it as much because a lot of people are fortunate enough to have a roof over their heads in the modern world. I find last fall the example with the guy down there at FTX, Sam Bankman, and I find it so fascinating that you can lay out this pragmatic perspective that you just laid out. On the other side of the country, down there in the islands, you got a young guy, this guy, Sam Bankman, taking every step polar opposite in terms of what you're describing. Everything is high octane, shoot for the moon. And what's so fascinating about now that that's been proven as another example of not the right way to go, but people still clamor for it. They still want more of it. They're sitting there ready to rehabilitate him. I mean, I know you. If you would have been in that position, everything would have gone to hell in a handbasket. You're not coming back. You just would have gone away. You'd be like, okay, I tried that. I don't want to talk to anybody else the rest of my life. That's it. I'm gone. But there's another type of individual out there, and I know you don't necessarily want these types of folks to be your clients, but there's another type of individual out there that they just keep taking high octane. Car crash, give me another car. I don't care. Let's go. And there's a whole army of people that are willing to go along with that.
Well, there's a whole army of people like Bankman-Fried For every one Sam Bankman-Fried you see that got onto the magazine covers, there were 50,000 that failed right out of the gate. They just have an insatiable appetite for risk and prestige and attention. And there's never a shortage of those people. So they will always come and they will write books about them and they will make movies about them. And some will go on to be wildly successful. Some will learn their lessons later in life and they won't blow up. But how they got to be famous quick and fast is actually a losing formula, net. Out of, say, 50,000, one of them will make it. That's actually a bad bet. Back when I was a teacher, my first job out of college, I taught intro to computer science at a junior college. And a lot of my students didn't care about the class. They all thought they were going to the NFL or to the NBA or Major League Baseball or whatever. And I remember going over the statistics with them, like how many people actually play peewee football and then junior high and then high school and then junior college and then D1 college. I think it's like 400,000 for every one person that actually gets drafted. And of the people that get drafted in the NFL, only about half of them actually make the team. And out of those, only about 1 out of 10 get a big payday, where the present value is worth more than what else you could have done with your life. Going through it all and seeing just how much of a lottery effect is actually happening there was instrumental. And the same thing is happening in the risk-seeking people in our industry, but we only see the winners. We don't see the losers until there's a huge blow up. So people get the wrong impression and think, oh, all right, well, the way to get ahead is to swing fast and loose with the risk. And that can be true in very rare circumstances, but it's never the way to stay ahead.
My nephew is in the middle of his freshman year at the University of Virginia. He's on the football team. He's a skinny white kid who runs like the wind. When I was talking to him over the holidays and I said, okay, UVA is probably top 50 school. We're not talking Alabama. They've been top 5 and 10 before, but these days they're probably top 50, something like that. But I said to him, I said, John, how many of the guys, and there's going to be some guys from UVA that will play professional. I said, John, how many of the guys right now at UVA think they're going to play professional? And he's like, all of them. You're not tracking or following these kinds of football statistics, but you as a learned guy could probably, with some educated guesses, determine in a few minutes, few seconds as to how wrong they are and to probably what the numbers really are. But when you're in the middle of it, it feels so close because there's one guy on the team that everybody thinks is going to be a first round pick and you're standing next to him and you could be him too. That's not the way the world works.
No, the tails are fat and there's just not a lot of data points in the tails. And you got to be way out in the tails to make it to pro sports. He may know 2 people that end up in the NFL. And then not only do you have to be amazingly talented, you have to not get injured. That part's out of your control. So it's just a bad bet all the way around. I once calculated the net present value of somebody trying to go to the NFL. I came up with a number. I can't remember what it was, but it was a deeply negative number. And that applies to all professional sports. But Mike, you can see why at parties I don't talk about this. This is not the kind of stuff that gets people excited.
I try to. They don't listen to me either.
No. They want to hear the opposite of this. The hero that came in and just knew to be there at the right place at the right time. That's what people want to talk about. That's human nature. But it's not the way to win in the markets. The way to win in the markets is realistic expectations, a plan, and discipline. And it's not exciting. I don't want it to be exciting. I'm not an exciting person, but that's the formula for success. Risk managed trend following is absolutely the most contrary, unexciting thing you'll ever do on a day-to-day basis.
Just to add a little more football story to it, I was thinking about it in the middle of sharing our stories here, but the new football coach at the University of Colorado is Deion Sanders, famous Hall of Fame player. And I saw an interview with him the other day. Okay, he's got more money than God. He's done exceptionally well. Everyone knows him. And they were doing an interview with him now as the coach of the Colorado football team. And he's sitting on the training table and someone's massaging his leg. And there's these insane scars up his leg. He's missing his big toe. He's missing another toe. All these surgeries he's had to have from playing the game. And that's another issue too, is we can go beyond football here quickly, but what kind of quality of life does one want? What type of risk does one want to take? And maybe you are that outlier that gets the bag, so to speak, in whatever the profession might be. But then if you get the bag, have you also destroyed something about yourself just to get the bag?
Well, I was just looking at some pictures of some of the heroes from the mixed martial arts back when I used to watch it, which was probably 15 years ago. And I didn't believe the pictures. A friend of mine sent them to me and I accused him of photoshopping these pictures. I mean, they're horrible. These people were at the pinnacle of the game 12, 15 years ago, undefeatable. And you wouldn't even recognize them today. They literally look like people that belong in a hospital. That's the cost, but you don't realize it until it's too late. We romanticize these things and give people a vision that is very inconsistent with Final Destination in a lot of cases.
As a young kid, were you always able to delay gratification?
Yes, and I don't know if that's something that can be learned or if it's just inherent in your personality, but I always had an intuitive understanding of the power of delayed gratification and the trade-off, the risk reward. In fact, you just reminded me of my first economic exchange. I was a little kid, probably 6 years old in Kansas, and we were going door to door selling Christmas cards to people. I don't know how I got onto that. It was just somebody came around and talked some kids into selling Christmas cards. And me and some of the other neighborhood kids went around, and this nice old lady came out and she bought probably $25 worth of Christmas cards. Being the idiots that we're like, okay, well, we met our quota. And this is in the 1970s. So we could take the rest of the day off. The very first person bought cards from us. And then it only took about 10 minutes for the other kids to say, hey, we've got $25 in cash. We can go spend it. And back then, $25 worth of junk food and video games was like winning the lottery. It was amazing. And I remember being terribly uncomfortable with it. And I was thinking, like, how are we going to deliver the Christmas cards to this lady? And the other kids looked at me and said, that's 6 months away. Why do you care about that? And I remember being terribly uncomfortable and looking at these kids, like I was outside my body, looking at this situation, asking myself, why am I so different from the other 4 kids that are already spending this poor old lady's money? And I didn't stand up to them. I let them spend the money. And then I don't remember exactly what happened. I remember Christmas came and there was a lot of disappointment and the other kids were nowhere to be found. And it's kind of a boring story, but it reminds me of that delayed gratification. It's kind of a close cousin to that, is analyzing the risk reward of your decision and worrying about what's going to happen in 6 months when you can't come up with the product that you promised.
I know you don't have the ability, I don't have the ability to forecast events, but is there something in your strategy or philosophy that allows you to look at a moment in time, for example, right now, and think about that moment in time as either elevated or not elevated? If I allow myself to go onto Twitter and I follow a diverse group of people, it's amazing that you can see, for example, I guess this week, the headlines were Kramer was yelling buy and Michael Burry was yelling sell. Do you allow yourself, or is it any part of your philosophy or strategy that you allow yourself to, when you're speaking on a podcast or speaking to clients, that we are in an elevated risk moment or not? Again, given that you don't have the ability to predict the next big event, the next crisis coming down the pike, but how do you speak with people when it comes to whether you perceive elevated risk or not?
It's hard to get around that one because it's something pretty much everyone wants to talk about all the time. The word useless keeps flying around in my head. I think it's useless to agonize over that if you have a plan and you're prepared, because there's really no way to know. I have a saying that we're always one missile launch away from a massive bear market. Always. Unless you can predict when that's going to happen, then you really don't have anything. I was thinking about you the other day because I was having a debate with one of my coworkers, and we were talking about how in 1998, no one was prepared for long-term capital management. I don't know anyone who was prepared for that. No one was prepared for what happened in 9/11. No one was prepared for the tech blow up in 2002. No one was prepared for the meltdown in 2008. And then evidently, no one was prepared for what happened last year in 2022. But there's no shortage of hundreds of thousands of man hours and hundreds of millions of dollars have been spent on research of people trying to prepare for these things. And yet no one ever seems to really be prepared. So that's the kind of base rate statistics I pay attention to. I look at it and say, all right, well, that to me is a failure. So I'm not going to follow that model. Instead, I'm going to have a plan that I believe in, that's empirically sound. And I'm going to commit to having the discipline to stick with that plan. And that plan is going to have rules in place to allow us to deal with any kind of market condition that I can conceive of. Now, that doesn't mean we're going to thrive in all the market conditions. That's not possible. You can't have something that thrives regardless of what the market does. But you can put together a plan that reflects your intentions and your desires to not take too much risk, because all you can do is through your position sizing and whatever hedge you have on when disaster strikes. You can't wait for the disaster to strike. Everyone thinks you can, that I'll just be faster and smarter than everyone else, but that's not possible. So at the end of the day, I look at it and say, I don't think there's a lot or any value. It's actually negative value for sitting around agonizing over, is the market risky right now? Will it be risky tomorrow? Just have a plan that you believe in and stick with it and try to always be prepared. That's the best I can do. And I think that's better than what I see most people in the marketplace actually doing.
Do you get a chance to give that answer on other interviews, or do you have to give some semblance of playing along to say something where I know you fully enjoy just giving the answer you just gave?
I'm not sure. I don't think that particular question comes up, but the concept I just went over, I don't recall saying that in such a concise manner on previous podcasts, no.
As you were laying out all the events of the last 25 years, it made me think all the people that would have had rose-colored glasses on saying something to the opposite. Is there going to be the ability with some of these AI creations to easily go back in time and grab all these headlines? Give me all of the headlines, some XYZ names that were saying this kind of rosy scenario, because then that becomes such an interesting piece of work. It's very difficult to find all that information. I feel somewhat lucky having gathered information over such a long period of time. But if I was to wake up today and say, oh, let's put together 220,000 words of a trend following book, oh my God, it's too damn hard to figure it all out and put it all into one somewhat concise book. It's difficult to find the data.
I've been working with a bunch of different AI programs recently, just out of curiosity. And what I found, well, first of all, they're evolving very quickly. 6 months ago, they seemed to be pure. Now they've learned to become more, I guess I would say, politically correct. They're starting to put disclaimers in there. I mean, I don't know where they're getting this information from, whether they're some human beings are telling them, hey, don't talk like that, or if they're actually learning through feedback or more consumption of information that's out there. I'm not sure. But I'll tell you this, having spent considerable time messing around with these different AI systems, at the end of the day, what they give you is the consensus view. ChatGPT, the rest of them, they're giving you a really thorough, distilled version of whatever the consensus view is of all the information out there on the internet. And that's super powerful for certain things. It's the end of the world for other things, though. Still, a human being has to delineate between where do I want the consensus view and where do I want anything but the consensus view.
I've seen some of the headlines too. I've not logged into any of them yet, but I've seen some of the output posted on Twitter, and some of the output alone causes me to say, why am I lifting a finger to even play with this? Why do I even want to be involved? It feels like more than a waste of time, but I guess it will be interesting to see the evolution. And ultimately, these are programmed by people.
It's true, but I think more than that, they're getting information that was produced by people. They're coming to conclusions that other people have come to. I meant what I said, a consensus view. But I would encourage you to play around with them because they're incredibly powerful. There's a few topics, and I won't go into detail, that have befuddled me for 6-7 years now. Technical topics having to do with different time zones and correlations and cumbersome stuff.
But it helped you.
It helped me to get to the consensus view, which when it comes to trigonometry and calculus, I'm going to agree with that. If it's hard sciences and you want to get to the consensus view of the moving parts, not the conclusions, because those are subjective, should you do this? That's a different question. But if you want to learn about how to do something, these AI tools are magnificent. 6 years, it took me 45 minutes to get all the answers I was looking for after 6 years of banging around on Google and reading books. If this was a video stream right now, you'd see my library behind me. And these are just 10% of the books that I've read over the past 20 years. 45 minutes, I was able to get all my questions answered. That's kind of amazing.
It will be interesting to see the various investment products that come out of AI, at least the marketing lingo of AI. I would think those are going to be coming down the pike quite quickly, where some enterprising future Sam Bankman will be telling us all about how nothing can go wrong because this came from the AI.
Well, let me share with you my philosophy on that, because I am not a proponent of using AI for the key aspects of investments. So because these markets are discounting mechanisms, if you get an edge over other people that is structural, that edge will go away once you exploit it. It's what bedevils the arbitrage guys. As soon as they find something that works and they start to do it, they close the gap, and then other people see what they're doing and they copy them. The gap gets closed further and whatnot. Because of my philosophy, and I can't claim to be 100% right about that. It's not provable. It's circumstantial. But I personally believe that there are 3 or 4 structural risk premia in the world that you're entitled to a return. If you exhibit behavior X, you will get return Y. And Y is variable. It could be 20%, it could be 2%, it could be negative some year, but over time, you'll get some compounded return if you do this accretive thing to the marketplace. And I believe there are 3 or 4, some people believe there are 5 or 6 structural risk premia in the world. And they're probably right. I just can't get the 6th one. It requires some sort of a structural advantage like Rentec or Millennium or market making type stuff that I just can't do from Arizona. But I can certainly do a good job of capturing those 3. Now, I turn around and look at the marketplace, and most of the products, 90% of the money in the world is focusing on the first 2 and totally ignoring the third. And the third is actually more important. It's the key ingredient that when you blend it in with the first 2, you get something that's fantastic. And that's what everyone needs. And Standpoint's job is to convince them to want what they need. AI, the way people are using it from an investment perspective, is typically trying to give themselves an edge over other people that are focusing on the first 2 risk premiums. And I think that is not necessarily a waste of time, but it's just not interesting to me because that war is being fought for 200 years. Smarter, faster, better fills, all that stuff. They're in the shallow water with all the other sharks fighting over chum. I want to go out into the blue ocean and collect those other risk premiums that they're ignoring that are incredibly valuable. And that's a philosophical difference that I think is key to understanding, because that's where the real opportunity is. And I'm glad that very few people agree with me in the industry.
So you don't wake up every day thinking to yourself, I must get a server closer to the exchange than Rentec.
No, I go the exact opposite direction. So the strategy we're running today, I could have run it exactly the same way in 1970. That's crucially important to me because the structural risk premium that I want has to be something that's enduring and endogenous to the markets themselves. It has to be something that actually makes the markets function better and makes them more healthy. And that's why I always talk about the hedgers. I feel like if I'm not providing liquidity to hedgers, then I'm not really earning a risk premium. It doesn't mean that I won't make money over some period of time, but it's not anything I can truly believe in. But if I'm providing liquidity to hedgers, and that's what trend followers do in the futures world, most of them don't know it. That's accretive because it's providing liquidity so that hedgers can hedge, which allows them to massage and increase their production on outputs or inputs as well for short positions. So that's just a different philosophy. You don't need an AI to learn that lesson. It's one simple lesson. You learn from observing how the ecosystem works and realizing these guys make money because of X, these other guys make money because of Y, and these guys over here make money because of Z. I understand how it all works. Is there enough room for me too? If there is, I'm going to go in there, collect my risk premium, pay my dues, case closed.
I think it was David Drews who told me he learned trend following through the hedging mechanism, seeing the hedging money going to the speculators. That was where his light bulb went off. And I thought that was the only person I've heard say that he came into this world that way.
Dave's smarter than I am because I saw the same thing and just didn't put 2 and 2 together. I saw the same thing back at Wichita State University during the 90s where I had set up a club and a lot of guys that worked on hedging desks around town, whether it was Koch Industries, Cargill, a lot of money in Wichita, a lot of corporate hedging and farming and agriculture and energy too. And when I realized these guys working on the hedging desks, we were sharing computer code and teaching each other stuff. And we had a Bloomberg terminal. And when I looked at what they were doing, I thought, aren't you losing money? And they looked at me like I was crazy. And they said, well, yeah, of course we're losing money. I thought, well, why would you want to lose money? I didn't understand what their motivations were. Look at their compensation packages and whatnot. The hedgers lose money on their hedges because their hedges are negatively correlated to their core business. And they need that negative correlation to smooth out their cash flows. When I really dove into it, and it was years later that I kind of put two and two together, around the time that I read your book, The Turtle Trading Rules, which was a great mathematical way to understand what's actually happening, I realized that this is basically the inverse of those hedging models. You're providing liquidity to them. They like to buy markets that are down and sell markets that are up. Trend following does the opposite. It's a zero-sum game. If you look at for every long futures contract, someone else has to be short. It just clicked for me. And then I really started to dig into it and thought, well, how much can they lose? And then looking at the leverage levels of the trend followers and saying, all right, that kind of makes sense. Why would the hedgers who have more information about the fundamentals lose to trend followers? Because it lowers their cost of financing if they're hedged. And that's their biggest expense. I could go on for weeks about it, but just thinking things through and seeing where you fit in the ecosystem and whether that's sustainable or not is more important than getting good fills or having an AI pick which assets most oversold.
Back to when you were mentioning the strategy working in 1970, the tech of 1970 would work for you today.
Is that a question?
Well, I mean, it's true, right? Your strategy today could utilize, not that you want to, because things are easier with some of the fancy new devices, but the tech of 1970 could be utilized for your strategy of today.
Yeah, that's a true statement. It's not going to convince anyone to trust us.
We're in the weeds with that one. People are going to really have to go unpack that as to why that's an interesting rabbit hole to go down as to why the tech of the 1970s could be used by Eric today to operate your trading part of your business.
Yeah, and I mentioned that that's actually very important to me because if we're reliant on speed, that makes me uncomfortable because we're not always going to have speed. Sometimes the markets are closed. You could have something like what happened with nickel. When they close the market down, you could have another terrorist attack. You could have a cyber attack. I mean, we just had a cyber attack in Europe a couple of days ago that shut down a lot of the futures industry for a day. So if you're reliant upon speed when you don't have it, what happens then? And I saw no advantage to the speed. In fact, there's a benefit from participating more slowly. You put some of the short-term mean reversion on your side. And I think that a lot of these guys that run firms that have been successful for 20, 30 years, like Charlie Munger, Warren Buffett, and then the futures industry too, AHL type. I think that if you looked at what they actually did, and they were being honest about where the real bulk of the profits come from, that not much has changed over the past 20, 30, maybe even 40 years. I really do believe that. The rest of the stuff, the marginal stuff at the edges, is more for marketing purposes and that continuous improvement mentality.
I love that you just asked me, was that a question? Because these days I find myself, I like not asking questions these days. I just like making a statement and letting other smart people pick me apart. This guy Coveil just said something. What does he want me to do with it? Is it a question or do I just dive in? Just dive in. And I'm finding more and more people just dive in. Some people are petrified by that approach, but you seem to do okay with it.
Yeah, I think I'm okay with it. I have the luxury of having a simple business model and a simple product that I believe in. Impromptu conversations don't bother. My answers aren't going to change. Structurally, we use different analogies and metaphors from time to time, but my answers haven't changed in years and they're not going to change going forward. They are what they are.
When I do this podcast, I'm not trying to do Mike Wallace 60 minutes. My objective is, okay, I get to select who I want to have come on. So if I select XYZ group of smart people, my objective is to let them teach me something. And then if they teach me something, if I learn something from them and everyone else wants to listen, then we've got winner, winner, chicken dinner. That's the approach.
I think in our industry, futures-based trend following, guys like me that are running product and then people that invest to them focus on all the wrong stuff. There's just 3 or 4 moving parts that make all the difference. One is capital efficiency. How often do you talk to people about the capital efficiency of using futures, which just require a small margin deposit, and then you're free to do what you want with the rest of the cash? How often does that come up?
You just brought it up. Thank you. I don't even have to think today. Next time you're writing the questions. I don't have any questions here. I actually doodle most of the time when I'm asking questions because I'm not saying I'm the greatest interviewer or anything like that, but how many times per week do you get a chance to have the conversation where you get to really say what you want to say as opposed to you're having to cater to the audience or you're having to dumb it down or whatever. I hope you don't dumb it down with me. I don't think you do. You could probably go a lot deeper, but you know where I'm going.
Yeah, I do. It's like once every year do I get to have just a no holds barred conversation.
Is this no holds or is this some holds? I can't tell.
It's pretty much no holds. We haven't done anything crazy, but yeah, I would say that this is the most open format.
I can't get anything crazy out of you. I don't even try. Why would I try to get something crazy out of you? It's not you.
Well, I don't have much crazy to say. Managed futures is a very frustrating asset class for people. And you talked about this in the beginning. Are people changing their minds now after a year like 2022? And my answer is pretty much not. I think people have realized that holding pure managed futures is very difficult for them because they don't actually want that level of diversification. They need it. And sometimes they want it, but they don't want it when it's not paying off. Here in the managed futures industry, we tend to shy away from addressing that topic head on. We shy away from telling it like it is. And that's just the legacy of the frustration of alternative investments and individual investors. I mean, what do you hear from people that are in my shoes talking about why people don't use more managed futures or trend following in their portfolios?
People are batshit crazy. I mean, that's the bottom line. From my perspective, for people to look at the last 25 years and to not be able to imagine something even worse when it comes to the equity market meltdowns, to not have that ability to imagine something worse just seems like some type of a mental disease. How can one not? This is not a trend following sermon, what I'm about to say, but if you just look at the players, the way the Fed does things, the bubbles that have burst, you throw in the Big Short movie, you throw in long-term capital management, you throw in 9/11, you throw in a pandemic. And for anybody to sit in the middle of that and go, oh, I just trust the 60-40 split. I trust Wall Street. Yes, sir. Can I bend over and have another? I mean, my God, people are nuts.
Let me play devil's advocate for a minute then. Well, what if their response was, I can't keep my clients if I bring trend following in a meaningful way into the portfolio?
If we get one of those mother of all mother kicks in the butts, they won't have any clients.
That's true, but the relative performance envy is so strong. And this is what I pick up on. If you underperform the US stock market for 3 years in a row, even by just a little bit, the financial advisors don't have any answers for that. The appearance of higher fees, there are more taxes associated with a managed futures program than just pure equities, but less than bonds. There's more to it than they're just all batshit crazy.
I was at a cocktail event in Ho Chi Minh City, Vietnam last fall with a bunch of the big swinging you-know-whats and a lot of hedge funds there, a couple over $1 billion and one guy with one of these, quote, billion-dollar funds. He came up to me and he knows about me and he knows about my work. And he said, how's it going? Da, da, da. I said, hey, how are you guys doing this year? Da, da, da. And he said, oh, well, relatively. And I just looked at him. He caught himself. He goes, yeah, it's not going to work with you. I hear that word relative and I'm like, oh, come on, please stop. Please stop. Don't make me go through the torture. I can't take it.
So what we did at Standpoint was acknowledge that that's an uphill battle. I fought that fight. Even if you convince people to put enough managed futures in their portfolio to make a difference, they can't convince their clients to stick with it. They just can't. I've seen all the evidence I need to see. It was a couple team members that I have at Standpoint that said, your personal portfolio, Eric, is basically equal risk contribution from global equities and managed futures or trend, our own system that we designed. Would people be able to stick with that? And I thought, let's find out. So in a roundabout way, trying to get someone to put, say, 5% into pure managed futures is excruciatingly difficult. Trying to get them to put 10% into a blended product is actually quite easy. But mathematically, they're the same thing.
Well, congrats on that particular way of skinning the cat, because I see some of the numbers here and there. So far, you guys seem to be growing quite nicely. So congrats to that. And where can people check you out at Standpoint? Where's the best place to go?
Yeah, it's super simple. Just go to standpointfunds.com, scroll down to the bottom, type in your email address, and you'll get our monthly update. I'm very proud of our monthly update. We don't have a bunch of junk and filler in there. It's just the facts. People find it very interesting. We don't spam the heck out of you. We just send you the monthly update, and people have been happy with that. And you can see the comparisons. Also on our website, we've got a library of all of our content. So you can see all the videos we've created and papers, some interesting articles that we think are relevant.
I think I might do the best job of getting you to the Eric persona is the Eric persona, but I can feel sometimes I get you to the edge a little bit where you can laugh about some of the crazy stuff in this world. To get you to that point, it's fun. But thanks for coming on and sharing today.
I try to find solutions. Don't get me wrong. I have my cathartic conversations with coworkers from time to time, but really I want to get to solutions and find good fits. So that means trying it this way. If that doesn't work, then you cut your losses and you move on. But at the end of the day, to have a successful business, there needs to be demand for what you're doing in the marketplace. It's incumbent upon us to get people the trend managed features that they need, but in a format that they actually want. And that's all we're trying to do. And it just so happens that coincidentally, that happens to be the personal portfolio that I believe in. So I feel lucky in the sense this kind of fell on my lap and I can do that for a living. I would do that for free. So may as well go ahead and do it for a living. And trying to not be frustrated with people is easy this way. Because if someone passes on that, that's fine. But I can understand why a lot of people pass on pure managed futures. They need it, but their clients don't want it. So it's an uphill battle, and I get it.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.